Internal controls for cash are very important because of the volume of cash transactions and the fact that cash can be taken, it can be spent, it has considerable value to an employee. If you compare this to, say, inventory theft, well, to be able to have a value from that inventory, either the individual is going to use the inventory or they're going to have to sell the inventory, so they're going to have to develop a market for it. You don't have to develop a market for cash. Cash is in itself a very valuable thing. And therefore, it's the portability of it, the ability to just stuff it in your pants and walk out with it. It possesses then a high risk of theft. Businesses then receive cash receipts, and they're going to receive their cash in several different ways. They can receive cash directly from an individual, or they can receive it from electronic transfer. In either instance, the primary internal control is this desire that the business gets the right amount of cash and it goes as quickly as possible into the bank account. So you don't want to have cash laying around or staying around. And you may have seen several ways in that businesses are trying to encourage you to pay your bills and pay your bills through electronic transfers. You paying your credit card bills now. I know probably some of you are paying those through an automatic withdrawal from your bank account. They may send you an email that warns you it's going to be coming, the amount's going to be coming out of your bank account, and then they take it out of your account. And this is something that you can set up. It saves a business in several ways. They are not having to process all those payments, the cash that's coming in, and also it is saving them because they don't have to worry about so much the internal controls associated with the handling of cash, because they eliminate this individual who is handling the cash. It's going directly into the bank account. The point here is cash receipts is an area where you have to have it covered. You have to think about it. You have to think about the ways in which theft could be occurring or errors in the handling of cash, and you want to get that cash directly into the bank so the appropriate amount of cash is received in and goes directly into the bank. With segregation of duties we talked about before, we said it was record keeping, authorization, and custody. And in cash receipts, generally what we like to see is we like to see this a cashier or a person coming in and receiving in the cash. So there has to be a point where the cash is received in, and this individual then will collect the cash from the customer, and it'll be placed in the in a register. As we said previously, this cashier should have responsibility for that particular cash drawer. And then after the cash is at the end of their shift, at the end of the time when they're working, all this cash is going to be combined and it's going to be given from all these cashiers to the supervisor. Oftentimes you see another terminology for this supervisor, and we call it treasury. We call it the treasurer function. The supervisor is going to count the cash in the drawer, compare the cash that's counted or the new cash that's come in to the cash that existed when this person took their drawer to their station and started their work. So the amount of cash that they should have coming in should equal the amount of cash sales. If it doesn't, then it doesn't necessarily mean that the cashier is committing fraud. It could mean that the cashier is just having difficulty making change. Oftentimes the cash terminals now, will tell the cashier how much in coin to give out. Some of them are even automated, so they automatically dispense the amount and the cashier doesn't even dispense the amounts. So there are different controls that can be established to help with this, but the supervisor is going to compare the cash register with a cash count sheet, and it's an independent verification here. And again, this is sometimes called a treasurer function. They're going to take all this cash, they're combining all the cash from all the drawers, and then they are going to take it all to the bank. This needs to be done promptly. As we said previously, when you collect this cash, it needs to go directly as directly as possible into the bank account. So this needs to be done quickly. Now the accounting department is going to be not handling cash. So accounting is not going to handle cash. So this is a separation of record keeping, which is accounting, and the handling of cash, which is the custody of cash, which maybe you might think of it as here in the treasurer function, because they'll have the custody of cash. So the custody of cash and the record keeping of the cash are separate. Accounting's not going to handle the cash at all, but they're going to receive records. They're going to receive documents. One of the documents they're going to receive is this bank deposit slip that says it was taken to the bank. They're going to have the sales records that are coming through the terminals as the amounts are being scanned. So they're going to have amounts to compare it to, but they're not really going to handle the cash, or for that matter, the merchandise. And accounting will prepare the journal entry. If there is a shortage, when there's a comparison made between the drawer, what should be in the drawer, and was actually in the drawer, and again the supervisor or the treasury function will see this, then there has to be a journal entry done to make everything right. If it's not enough cash, it's called a shortage, which is an expense, and if it's too much cash, it's an overage, which is generally called a negative expense. So we generally put this amount into a miscellaneous expense type account, either as a debit or credit. I said there are a few times in this class where you're going to see credits to expenses, and this is one of those times. So the cashier ring up the sales, and the sales total $6,100, but there's only $6,097 in their drawer for a deposit. You have to bear in mind that there's always some cash in the drawer at all times, because the cashier may need to make change. So there's a base amount of cash, and we're not talking about the base amount here. We're talking about the sales coming in, and we're talking about the amount above that base amount that they're going to have at the end of the day to give to that supervisor. And they're only giving them $6,097. They should be giving them $6,100, so they're 3 short. When we record it this way, and it shows up as an expense. So we have sales revenue of $6,100. We have cash of $6,097. It's not $6,100 because we're $3 short, and the shortage is recorded as an expense. If you think about this, assuming fraud is not occurring, then fairly randomly we will have shortages or overages. In other words, if we combined all the shortages and all the overages from all the cashiers at any given point in time, the net amount would probably be 0, because the shortages and the overages would balance each other out, assuming we don't have a major problem. Now, if you have a constant shortage, it probably means you just have a cashier that's not doing their job very well. It could also mean, though, that you have fraud occurring from the cashier. Cash payments. This would be either writing a check or transferring funds for a purpose. In rare cases, you're going to pay for things with bills and coins, and when you do that, it's used from a petty cash system. Most of the time, we don't pay for things using a petty cash system. Most of the time, what we will do is we will cut checks. And companies like to cut checks because then you have a document of the actual amount that's paid, and the banking system provides you with the records. So in cash receipts, we had a goal, and the goal was to try to make sure that we got everything to the bank promptly and that the cash receipt was for the right amount. Our goal here in paying it is that we're only going to pay the amount in the transaction, and that amount is for an authorized purpose. It's a business purpose, and the business has authorized this payment. Now, the steps involved in this, in creating or paying for controls, often involve a voucher system. And a voucher system is just a system that says we need to have support for everything we're doing. So we have support for all the payments. I'm not going to go through all the steps involved here. The voucher system creates procedures to have in place, and so we are sure of the amount, who's to be paid, and then we use this to actually write the check. So we create a voucher that summarizes the business purposes, the accounts that are going to be involved, and then we will cut the check. We said oftentimes you're not going to cut a check though, and you're going to have petty cash. And I think some of you probably have seen this. Oftentimes it is the secretary or the administrative assistant who has a little cash box, and they use it to pay miscellaneous things. They might have to pay to the delivery person. They may have to pay for a delivery of food, the food having a business purpose, and it's being delivered, and they need to pay the caterer, or they need to pay a Pizza Hut who's bringing the pizza. I hope that your teachers from time to time give you a free pizza meal, or you have them with your school organizations, so you understand what I'm talking about. There needs to be some cash transferred, and if the requirement is that it needs to be paid with cash, and it's a small amount, it has to be a small expenditure, and it has to be done on behalf of the organization, then oftentimes they'll have this petty cash box. And the person who handles it, who's responsible for it, is called a petty cashier. I know, isn't that funny? But that's a technical term for it. Just like when we had fraud happening, we said the person who committed fraud was a fraudster. Here's another strange term. It's called a petty cashier. So, like the cash drawers at Walmart, this petty cashier is going to be responsible for all the cash that goes out of this box. And every time something goes out, they need to collect a receipt. So what we want our petty cashier to do is to have receipts, and the receipts should represent all the outflows. So at the end of a time period when it seems like their drawers or their cash box is getting low, the petty cashier is going to note that it's getting low. They're going to count up what they have left. And if they started out with $200 and they only have $10 left, then that means $190 has gone out. So they need to count up their receipts, make sure they have receipts for $190. If they don't have receipts for $190, again, it's the same thing as we were talking about with the cash drawer and the employee with the cash drawer. If it is short, it could mean that they are committing fraud. But with a petty cash system, usually the amount of cash that they have is so low, and combined with the fact that they really don't want to lose their job, so there's not much incentive to be gained from taking it, they probably will not be committing fraud. Probably what's happening is they're just not taking enough care to get all the receipts they need to have. They also may not be keeping it locked. It needs to be kept locked, and the petty cashier is the only one who has the key. You need to go through these, and you need to check this amount and what's there at the end of the accounting cycle, around the time the financial statements are done. This is to ensure that all those expenses that are being paid with cash actually are recorded, and you're going to see that in the next voiceover.